Our next guest is in charge of corporate credit at Goldman, advising America's biggest companies on their multi-billion-dollar financings. Jonny Fine's here at Post 9, Goldman Sachs Global Head of Investment Grade Credit. It's great to have you back, Johnny. Welcome.
Good morning, Carl. Thanks for having me.
I love your line that corporate bond liquidity has never been better in your career.
Correct.
In your view.
Correct.
What accounts for that?
So I think there's been a lot of evolution within the corporate bond market over the last 10 years, and probably more accelerated so over the last 5 years with electronification. The growth of ETFs that have become a major source of risk transfer in the credit markets, as well as portfolio trading, which you can think of as a bespoke, customized ETF that now together represents around about the third of all the trading volumes that we do between IG and high yield at Goldman Sachs.
And all that volatility in April kind of didn't really impact volumes, right?
Actually, it created an increase in volumes. Like when I kind of think about what are the markers of liquidity, it's the volumes that trade, it's the response under stress, and it's bid-ask spread. When we kind of think about that second factor, response under stress, I mentioned ETFs. They represent, for the most part, around $10 billion on an average daily traded volume basis. During April, that went up to $30 billion. And we've seen this time and time again over the last several years, that this response is a greater array of trading activity in times of stress in credit markets, very much in the same way that it has been in equity markets as well.
Didn't think we'd start off on liquidity, but since we're there, Johnny, I wanted to get your take because I, spoke to Mark Rowan on Monday and Jonathan Gray, both, of course, who have very major efforts underway at their respective alternative asset managers in the private credit markets. Rowan, in particular, who's been a spokesman for those markets for some time, talking about, hey, in 18 months, you're not going to know the difference between private investment grade credit and public. Take a listen to what he said, because I would love to get your response.
Okay.
We have 10% of the trading capital in the world for fixed income that we had in 2008, and markets are 3 times their size. We have a historical, nostalgic view that there's liquidity in fixed income markets. There's not. There's only dealer liquidity. Why should what's happening in a private investment grade be any different than a public investment grade?
All right, Johnny, your chance to respond to Rowan.
So I never like disagreeing with Mark, first of all, because it hasn't really paid very well to do so, given how successful he's been. I think when I think about private credit, and I think about it as an alternative source of capital for the clients that we cover and engage with every day, I see this as an incredibly welcome alternative to the public credit markets. The public credit markets are standardized markets. They have standardized disclosure. They have credit ratings from S&P, Moody's, Fitch, the 3 biggest rating agencies in the world. They have standardized reporting, and the securities that are issued in the public market are standardized in many ways as well. That means that the investors that traffic in those securities generally will pay a premium for that standardization. The wonderful thing about private credit as it has emerged is, first of all, it's emerged at scale, and secondly, it's emerged as a bespoke, customizable source of credit for issuers who want to access that channel. And so, of course, it will grow in liquidity because the size of the market is growing as fast as it has been. But the relevance of it as a solution for the clients that we cover, we've rebranded our business the corporate solutions, the capital solutions group, as opposed to solely just the financing group, because we want to be able to advise our clients on all of the alternative ways that they can think about raising capital, whether it be public intermediated, whether it be private capital from our own asset and wealth management group, whether it be intermediated private capital, which is looking more and more.
But what about this argument that really you guys, you just started off talking about liquidity and there being a lot of it? Rowan says that's nonsense. It's not true. We're nowhere near where we once were prior to the financial crisis.
So the amount, where is correct is 100%, is that the dealer capital and dealer inventories that once sat on balance sheets at the banks, that doesn't exist anymore. That doesn't exist anymore to the same degree because of the way that financial regulations changed post the global financial crisis. What's happened instead is that capital markets sat there and they bemoaned the lack of kind of change in regulatory reform to enable balance sheets to be committed to this business more successfully again. So instead, they created these evolutions. And the evolutions that were technology-based, again, ETFs, portfolio trading, that has been what's reliquified the corporate bond market. And as I said, made it more liquid than in any other time that I've seen during my career.